Sup. How y'all doing? 4:30. The bar is probably not open yet, but we'll make this quick in 20 minutes. All right, boom times. I wrote this presentation about 4 days ago when I was on the flight from Argentina over here, and then I kind of had a change of heart and sort of change things up. So, yeah, I still believe there's a bull market coming. It just might take a little bit longer than I initially thought, and I'll lay out some of my thoughts here and see if you like it or you don't, and we'll start moving. All right, so first thing is, this is a great chart that I love that Luke Roman has been sharing a lot, and it's the price of gold in German marks during the Weimar Republic back in the early 20th century. And the message here is that Bitcoin and crypto are fucking volatile. Don't get shook, don't get liquidated, stay the course. Shit isn't always gonna happen the way the people like me or someone else or even yourself think is gonna happen, but if you're very patient, then hopefully in a few years everybody's driving Lambos. So just a little disclaimer. So basically, we've been waiting for this Fed rate cut for, I don't know, a year and a half now, and every few months, all the pundits get on TV and on the airwaves and Twitter and whatnot and talk about why there's an imminent Fed rate cut and how it's going to be super bullish for asset prices. And after 18 months, we finally got the confirmation that our monetary masters at the Jackson Hole Circle Jerk in Wyoming decided that it's time to cut rates. And we all rejoiced, and Bitcoin went up, I think, to like 64,000 on the day, August 23rd. And ever since, it's kind of been crickets and stuff's down again. So I kind of had an inkling of like, why am I have this consensus opinion that a Fed rate cut is positive for risk assets? And as I'm on my flight from Buenos Aires today, I pull open my Bloomberg, and I saw that the reverse repo facility, which is essentially just a deposit account at the Federal Reserve, the balances were going up when I thought that they were going to go down. And I wrote extensively about this, about how Janet Yellen and the U.S. Treasury were engineering stealth quantitative easing by issuing lots of T-bills and getting their reverse repo balances to go down. But they're going up. So what the fuck is going on? And my theory is that T-bill rates are going down because the Fed's cutting rates. And so money market funds that invest in these things are moving money back into the reverse repo and actually sucking liquidity out of the system, and that's negative. And the second thing that I thought about a bit was, well, if the Fed in 2023 paused and we had about a 10% correction in the S&P and 10-year yields went to 5%, and a month and a half later, Yellen came in with a pivot in terms of issuing more T-bills to jack the markets, how is that any different than this year when the Fed is going to cut rates in the face of large government deficits? Is the bond market reaction going to do the opposite what everyone thinks and rates go up instead of going down? So I'll explore these two things, and hopefully maybe I've changed your opinion a bit by the end of this. All right, so I love fucking charts. Here's some chart porn. This is a chart of the 1 month, 3 month, and 6 month T-bill. So the theory goes, if I'm a money market fund manager, my goal is to maximize the amount of yield that I can earn in a safe way. I can either put my money at the Fed and earn 5.3%, which is essentially almost the midpoint of the lower and upper bound of their policy rate, or I can invest in the Treasury bill market. The risk is the same. Your counterparty is the U.S. government. It's just a different type of instrument. So if the T-bill rates are higher than the reverse repo, I'm going to take my money out of reverse repos and put that into T-bills. If the T-bill rate is less than reverse repos, I'm going to sell T-bills and put it in reverse repo. So the horizontal line here is at 5.3%. And as we can see, rates started collapsing below that line starting in late July. The 3-month and 6-month rate went down a lot farther because of the yen carry trade unwind. Again, I can't really explain that here. It's a bit complicated and takes a lot of time. But the 1 month rate stayed about 5.3% or a little bit above because the market hadn't believed yet that the Fed was going to actually cut rates. And the purple magenta line, as you can see here, is on August 23rd. That's the day when Jay Powell stood up and said the Fed was going to cut rates because they were afraid that the jobs market in the US was faltering. And as we can see, the 1-year rate started to gap down and meet the 3 and 6 month rate because now In 1 month, the rate will be 25 to 50 basis points lower than it is today. So a bond that's going to mature after September 18th should yield close to what the Fed funds rate will be at that point in time. So what we have now is that the reverse repo is the highest, safest rate that you can earn as a money market fund. And as such, they took money and put it back into that facility. And that's what this chart here is showing. This is the reverse repo. Every day it's published by the New York Federal Reserve. And I track this very closely because Bitcoin responds very favorably or disfavorably to reverse repo balances going down, which is liquidity positive, or reverse repo balances going up, which is liquidity negative. And as we can see, starting on August 23rd, the exact date when Powell said that rates were going to come down in 1 month, reverse repo balances started rising to a tune of $120 billion. And this coincides with T-bill rates crashing below, well, not crashing below, trading below 5.3%. So the cause and effect is direct. I've moved T-bill rates below 5.3%. Money market funds responded by putting money back into the reverse repo. And when money is in this facility at the Fed, it's sterilized. It's not used to leverage throughout the financial system. It doesn't allow our assets to pump like it has done since September 30th of 2022, when we went from $2.5 trillion in the reverse repo facility down to now about $400 billion. And we know the result in terms of the amazing returns that crypto and other assets have had since then. And so since August 23rd, what has Bitcoin done? We had this initial euphoric, yes, rate cuts, fuck yeah, buy the fucking dip. You know, $64,000 Bitcoin, now we're, I don't know, 59,000, 58,000, whatever it is. But we've almost got a straight line down. So this is a inverse. The gold line is the inverse of the reverse repo. It's falling, meaning the balances are rising, and the Bitcoin price is falling along with it. And so my theory is that this will continue so long as T-bill rates are below the reverse repo. So what can we expect between now and any eventual change in policy? Is that Bitcoin and crypto will be a bit weak because we're removing liquidity from the system, because now all these depositors are flooding the Fed back with money because the Fed currently at 5.3% is the best rate in town. So that's one pillar of general weakness and how I explain to myself why Bitcoin and crypto hasn't responded the way we all thought. The second is inflation. And so the Fed, if we remember, from 2022 in March to July of 2023, hiked rates at the fastest pace since the 1980s. Why? Because the U.S. was experiencing 40-year highs in inflation. So that's the white line here. You see it starting in March of 22 at about 9% and going down to about 3%. Now, the bond market wants to see the Fed being serious about fighting inflation. So if the Fed is hiking rates, then the bond market doesn't have to do it for the Fed. And so as we see here, the 10-year yield never crossed over 4%, even though we had, at one point, 9% levels of inflation. And this is the highest in 40 years. But the bond market was content that the Fed was serious about raising rates to curtail economic activity, make finances more expensive so that inflation would eventually come down. Therefore, yields didn't have to spike. That was in 2023. But what happened about a year ago in August of 2023? Again, we have the Jackson Hole meeting. And what did the Fed do? The Fed pivoted. It said, okay, we're done raising rates. We're going to pause rates. And everybody goes, yeah, fuck yeah, we're on the way to cutting rates, just like we did this year. But what happened? The market did the exact opposite. 10-year yields started rising, and they went all the way up to 5%. The stock market, which is evidenced in white, the S&P 500, that's CPI inflation, is at 3%. So at 9% inflation, 10-year yield was 2%. But at 3% inflation, the 10-year yield is rising to 5%. Why? Because the market is not happy that the Fed is not serious about fighting inflation. And it believes that there is still inflation in the system that needs to be expunged. And the result from August 23rd of 2023 until November 1st, when Yellen came in and saved the day, was a market meltdown. S&P dropped 10%. Regional banks started being afraid that they would fail again because their treasury portfolios were showing losses because yields were backing up to 5% on the 10-year treasury. And so what happened? As with anything in this, fake financial system that rules the world, whenever there's a problem, the authorities respond with printed money. Yellen came in and for the first time, I guess in US Treasury history, gave forward guidance that she would issue a certain amount of Treasury bills to drain the reverse repo and inject liquidity into the system. This was announced on November 1st of 2023. And that sparked a general market rally. Bitcoin went from about, 30,000 to 72,000, 74,000 in March. The S&P went to all-time highs. 10-year yields fell from 5% down to below 4%. The banks rose again because now their treasury portfolios were showing unrealized profits instead of losses. So the response was, hey, we're not going to fight inflation at the Fed. Instead of saying we're going to raise rates again, Yellen swoops in and offers more liquidity to pump the markets. And so back to what the market is really afraid about inflation. So this was a study that was released by MIT recently, and they studied during the COVID pandemic response, what was the biggest contributor to inflation in the United States? And it's government spending. But government spending isn't slowing down. State and local government spending in the United States is at the highest in peacetime history. The only other two highest periods are 2008 during the financial crisis and COVID itself. So the US government is spending more money than world wars, than the Civil War on a relative basis. That's why inflation is so high in the United States. Now, obviously the government can either borrow money or it can raise taxes. But politicians want to get reelected. They don't like raising taxes. Taxes are not popular. So the government continues to run massive deficits. And so in my mind, I'm like, well, the setup of this year is the same as last year. Last year, the Fed was doing the right thing. They were raising rates. And then they stopped. And the market said, fuck you, to 5% 10-year Treasury yields. Government spending keeps growing. You, the Fed, are supposed to raise the cost of funds to stop these politicians from spending so much money. And they didn't do it. But this time around, the US government is spending more money than they were last year, yet the Fed is continuing now to cut rates. And so I believe that the market is going to do something similar to what it did last year and say, fuck you to the Fed, we're going to take rates higher and cause some pain. And so this is, rip me a new Jackson Hole. This is the 10-year yield post the Federal Reserve rate pivot. And you would expect that the 10-year yield is going to go down as the Fed has announced its first rate cut in 18 months. But the 10-year yield is trading higher than it was when the Fed began. Now, we only have a week's worth of data, so we're going to see how September plays out in terms of how 10-year yields trade. My prediction and how I'm going to play my portfolio, and I'm not trading rates in itself, but I believe that 10-year yields are going to go quickly from the 4%-ish level that we are today to 4.5% to 5%. And that's going to trigger a policy response. And that's what we want. We want them to come in with printed money and pump our fucking bags. So again, who's coming to the rescue? Bad girl Yellen. Her job is to get Kamala Harris reelected. You can't have a falling stock market and a rising bond market 1 month before a general election. So what are the policy responses that are available to her and Powell? So Powell can stop quantitative tightening, which means he can start increasing the amount of bonds that the Federal Reserve is buying, which decreases bond prices. And the Treasury can run down its checking account. It can spend the roughly $750 billion that it has with the Fed instead of issuing more bonds, which is direct injection of liquidity into the system. So the goal of this is to increase the supply of money so that bonds can be purchased to ameliorate this Fed rate cut in the face of high and rising government deficits and sticky inflation. Now, this has to be much larger than the effect of the reverse repo rising due to people dumping Treasury bills. So I believe that this sort of response is going to happen late September or October, assuming that we get this sort of market dislocation between now and then. So crypto, obviously. What are we doing between now and then? Bitcoin is down 10% from the Powell pivot. I think we go sideways for a bit. Altcoins are continuing to get their fucking asses handed to them. I don't think that's going to stop. I like that because I'm just going to be buying stuff that I think is very cheap and continue to increase my positions with no leverage. But I think that the intervention has to come in late September or October. Again, general election is the first week of November in the United States, and if the politicians want to get reelected, they need a strong stock market. The public believes that the economy is doing well if the stock market's doing well. And if you have a banking crisis because rates are at 5%, that's also not good. You don't want your local bank down the street to be going bust and getting sold to JP Morgan 1 week before the election. It's just not good politics. So that's why I'm betting we have a strong policy response in a similar fashion to what we had in 2013 in November and 2024 in October. And we get what we always want, the resumption of the crypto bull market starting in late Q3, early Q4, and transitioning into the first quarter of next year. So that's all I got for you motherfuckers. Thank you very much.